Gold prices have been soaring, more than doubling in just 3 years. Some people are thrilled, seeing gold is backed by gold credit, unique and destined to only go up. Others warn that the gold bubble has peaked and a major crash is coming. So what's the truth? What's really driving this round of gold bull market? And how much longer can gold keep going up? Is it still worth buying now? Today, as a professional financial researcher and investor, I'll walk you through the logic behind gold's rise. In the first 7 or 8 minutes, I'll share some solid data-driven analysis. It might feel a bit technical, but it's crucial to truly understand gold. Then, we'll dive into the fascinating part, uncovering the real story behind gold's price swings over the past 50 years. Be patient. We'll start simple, go step by step, and by the end, everything will come together in a fascinating way. Let's begin with a basic question. What determines the price of gold? The most fundamental answer is supply and demand. So, what exactly are the supply and demand dynamics for gold? Let's start with supply. Gold supply is pretty straightforward. Gold is a metal that exists in limited quantities on Earth. Annual production is also limited. So essentially, we can think of gold's total supply as fixed. It doesn't really change much. That's what people mean when they call gold God's chosen asset, something truly scarce and reliable. And since supply doesn't move much, the price of gold is mostly driven by demand. Okay, so let's look at demand. To understand demand, we need to ask a basic question. Who's buying gold? Once we know who is buying, we can figure out why they are buying, and that's how we understand what really drives demand. Broadly speaking, there are 3 main types of buyers. First, consumers. These are people buying gold for personal use. Jewelry, bracelet, necklaces, rings, and decorative pieces, even gold foil on luxury food. Globally, this category makes up about 30% of gold demand. In countries like China and India, it's even higher, around 50 to 60%. There's also some industrial and tech demand, electronics, semiconductors, etc. But that's more, roughly 10% of total demand. Second, investors. These are people buying gold bars or coins as a store of value or hedge, hoping prices will rise. Investment demand accounts for about 40% of the global total. Third, central banks. Central banks are the third major buyer, responsible for roughly 15% of global gold purchases. Why do they buy gold? For monetary reserves. This is a concept I'll explain in detail later. Those numbers I just mentioned come from the World Gold Council's 2023 to 2024 data. But of course, these ratios change from year to year. At this point, you might be thinking, wow, there are so many different kinds of demand. This must get complicated. Actually, not really. Think about it. Do those consumers buying gold jewelry really do it just for decoration? Not exactly. The main reason people buy gold is because they believe it stores and preserves value. So, those so-called consumers are not really consumers. At their core, they are investors. Industrial and electronic uses? Sure, that's really consumption. But it's small, stable, and barely moves the needle each year. So if we simplify it, gold demand really comes down to 2 forces. Number 1, investment demand from individuals and institutions. Number 2, reserve demand from central banks. Now, let's go a step further. Why do people, institutions, and even central banks invest in gold? Gold is different from most assets. Land can grow crops, real estate generates rents, stocks produce profits and dividends. But gold produces nothing. So why hold it? Because gold serves a unique purpose. It acts as a quasi-currency. In the past, it wasn't quasi anything. It was the king of money. Gold ruled the entire monetary world. Every other form of currency, silver, copper, iron, even paper, bowed to it. It was the ultimate store of value, the one thing everyone trusted. Paper money, on the other hand, is created by central banks and commercial banks. They can print as much as they want. And when too much is printed, inflation happens and the currency loses value. Gold doesn't have that problem. Its supply is limited, fixed, and untouchable. That's why, even though it's no longer official currency, gold still acts like one. It's the ultimate reference point for all money. It's like the old emperor who's retired but still pulls the strings behind the curtain. Whenever paper money starts losing credibility, people instinctively turn back to gold to protect their wealth, to find something solid when everything else feels uncertain. In today's world of paper money, the US dollar has become the most widely accepted global currency. That means gold, in many ways, reflects how much people trust the dollar. When people are confident about the dollar, when they believe it's stable and strong, they hold dollars instead of gold. But when confidence in the dollar starts to shake, people sell dollars and rush into gold. So, when do people lose faith in the dollar? There are really only two main situations. First, when the dollar is expected to lose value, a devaluation crisis. Second, when holding dollars could face a payment or liquidity crisis. When people worry the dollar might not function properly as a means of payment. Let's start with the first one, devaluation crisis. When does dollar tend to lose value? There are two main types, short-term cyclical devaluation and long-term structural devaluation. The short-term kind is the most common. It's driven by the natural ups and downs of inflation and interest rate. Here's how it works. When markets expect the Federal Reserve to cut interest rates, holding dollars becomes less attractive because the yield drops. At the same time, lower rates usually mean faster economic recovery and more inflation in future. So, when people expect the US to enter a rate-cutting cycle, they anticipate a weaker dollar and buy gold. The opposite happens when the US is raising rates. Higher yields make the dollar more attractive, inflation expectations drop, and investors sell gold to buy dollars. This inverse relationship between gold and the dollar, or more precisely, between gold and the real interest rates, has held true for a long time. Look at this chart. The light blue line is gold prices, and the dark blue line is the real interest rate, nominal rate minus inflation. See how they often move in opposite directions? Especially here and here. There are some exceptions, of course, times when they move together, and I will explain those later. Now take a look at this chart comparing the US dollar index with gold prices. You can see it even more clearly. Gold and the dollar are strongly negatively correlated. When the dollar rises, gold tends to fall, and when the dollar weakens, gold surges. Besides these regular cyclical patterns, there are also shock events, unexpected crises that drive fear. Think of the COVID-19 pandemic or Russia's invasion of Ukraine. Whenever uncertainty spikes and the future feels unpredictable, investors flee to safety, and that safety is gold. Then there's the second kind of dollar weakness, the long-term structural devaluation. This doesn't happen often, but when it does, it's huge. It means the global fiat currency system, and especially the US economy that anchors it, is in trouble. And when that happens, gold enters what we call a super bull cycle, a massive, long-lasting surge that rewrites the market. Now let's talk about the second situation, a payment crisis. A payment crisis happens when countries that hold US dollar start to fear they might not be able to use or access them freely in the future. In 2022, when Russia invaded Ukraine, the US and Europe froze Russia's dollar and euro reserves, and even discussed using that money to rebuild Ukraine, essentially treating it as war reparations. That move shocked a lot of countries, especially those sitting on huge foreign exchange reserves like China. For China, which holds around $3 trillion in reserves, that was a massive wake-up call. And that, my friends, is likely one of the biggest reasons why China's central bank has been aggressively buying gold over the past 2 years. Alright, if you made it this far, great job! You deserve some credit, because the first part was a bit technical. Now it's time for the fun part, using the framework we just built to uncover the real story behind gold price swings over the past 50 years. But before we dive in, let's do a quick recap. Gold prices are driven mainly by demand, and the demand is shaped by confidence in fiat money, especially the US dollar. When people expect interest rates to fall, they anticipate currency devaluation, and gold goes up. When they expect rates to rise, they expect a stronger dollar, and gold goes down. When central banks start printing money on a large scale, gold also rises, and falls again when tightening begins. Unexpected crises, like conflicts or pandemics, create short-term spikes in gold. And when people start to believe the US or global economy is in serious trouble, that's when gold enters a super bull market. Alright, here comes the exciting part. Take a look at this chart. This is gold price movement since 1970. From 1970 to 1973, gold prices skyrocketed. Why? Because paper money had just been unpegged from gold. The Bretton Woods system collapsed, and the dollar took over as the new king. I'll make a separate video later just on this story, how the US dollar rose to global dominance. Then came 1973 and the oil crisis. Oil prices exploded, inflation surged, and the US was still deep in Vietnam War. Deficits and national debt soared, and the American economy fell into serious trouble. This was one of the worst economic periods since World War II. The US was hit by stagflation, economic stagnation plus runaway inflation. The Fed started raising interest rates, gold prices fell, but then the economy tanked. So, after 1976, the Fed cut rates again, and boom, gold went on one of the most powerful short-term rallies in history, soaring from around $110 to over $630 in just 3 years. Compared to that, today's rally is nothing, just a baby bull market. By 1979, tough guy Fed Chair Paul Volcker stepped in and slammed interest rates upward to crush inflation. Gold collapsed, and that crash lasted 20 years, all the way down to about $250 by 2001. So my friends, please, don't ever casually say gold always goes up in the long run, and don't claim I'm a long-term gold investor without understanding this chart. If you bought gold at $630 in 1980, you would have watched it fall for 21 straight years, all the way down to $250. You wouldn't have broken even until 2006, 27 years later. And if you factor in inflation, you actually lost a lot of money. In fact, you'd need to hold it until 2025, 45 years later, just to truly break even in real terms. So, whenever I hear people confidently say gold is backed by God's credit, it always goes up in the long run, I just want to smack them across the face with this chart. If you look at gold's real history, over the past half-century, you'll see long stretches, 10 or even 20 years, where gold just kept falling. Let's keep going. In the 1990s, interest rates were moving downward, yet gold kept falling. Wait a second, didn't we just see lower rates usually push gold up? So why the opposite this time? Here's the logic. Even though rates were trending down, they were still very high overall. Except for a brief dip to 3% in 1992, US rates mostly stayed between 5% and 6%. So even when the Fed was cutting, money was still tight, not enough to create inflation or weaken the dollar. Without devaluation pressure on the dollar, gold stayed sluggish throughout the decade. Then came 2001, and finally gold came back. The dot-com bubble burst, the economy stumbled, and Alan Greenspan slashed the rates hard, from 6.5% all the way down to 1.75%. That's a massive drop. And suddenly, everyone expected dollar weakness and inflation. Gold turned around and started a 10-year bull run, lasting until 2011. And what a decade that was! Rates stayed extremely low for more than 3 years, up to 2004. Inflation, weirdly enough, was very slow to rise. It bottomed out in 2002, then crawled up only a little. That gave Greenspan every excuse to delay rate hikes. And when he finally started raising rates in 2004, he did it slowly and half-heartedly. Each increase was small, spaced far apart. His reasoning sounded convincing. Inflation is only 3%. Why rush to tighten? Looking back, it's obvious why inflation stayed low. China has just joined the WTO. Many U.S. companies were no longer investing domestically. They were sending capital to China, building factories there. That means less inflation pressure in the U.S., because real investment is what usually overheats an economy. Meanwhile, cheap goods flooded from China to America's shelves, holding down the CPI even more. But here's the twist. Those US dollars earned by China didn't stay in China. The Chinese government reinvested them in US treasuries. So instead of fueling consumer inflation, all the money fueled asset inflation. A giant bubble in financial markets, especially housing. Sound a bit complicated? Don't worry, I'll make a separate video just to unpack this fascinating monetary loop. For now, just remember one key point. China's WTO entry kept US inflation low but created a massive asset bubble, the housing bubble. During this time, we saw something unusual. Rates were rising, but gold was rising too. Why? Because even though rates were climbing, they were still very low and rising very slowly. That kept fears of dollar devaluation alive, and gold climbed right along with it. Then came 2006, the turning point. Fed Chair Ben Bernanke raised rates just enough to burst the housing bubble. By 2007, the first wave of subprime mortgage defaults began. People couldn't pay their home loans. That's what we now call the subprime crisis. As soon as that hit, Bernanke slammed the brakes and paused rate hikes. Then in September 2007, he started cutting rates again. Look at the chart. Gold had been flat through late 2006 and early 2007 when rates were high. But the moment that the Fed started cutting, gold shot up. Investors knew what that means. A crisis was coming. Rate cuts wouldn't be a one-time fix. The dollar would weaken for sure. So gold kept surging higher. At first, people thought the subprime problem was small. By mid-2008, after several Fed rate cuts and emergency liquidity programs, markets looked calm again temporarily. But then came the shock. The housing bubble burst completely. Lehman Brothers collapsed. Fannie Mae and Freddie Mac were taking over. The global financial meltdown began. The Fed went all in, slashing rates to zero and printing money like never before. They called it quantitative easing, and under that massive wave of monetary stimulus, the dollar's credibility collapsed, while gold prices soared from around $260 in 2001 to roughly $1,800 by 2011, a 6.8-fold jump, with an annualized return of about 21%. This is another super bull market in gold. And by the way, I'll make another full video breaking down the 2008 finance crisis in detail, because that event completely reshaped the world's financial system. After the 2008 financial meltdown, the Fed kept interest rates near zero and flooded the system with liquidity for years. By 2011, the US economy finally stabilized. Yes, the European debt crisis erupted soon after, but it didn't drag America down too much. So markets started to expect the inevitable. The Fed would eventually have to end its easy money policy. That expectation alone was enough to stop gold's rally. Prices hovered near the peak for about a year. Then in 2013, the Fed officially announced it would begin tapering its bond buying program. In other words, tightening policy and preparing for higher rates. That meant less money printing, stronger dollars ahead, and sure enough, gold turned sharply downward. From 2013 to late 2018, gold spent nearly 6 years falling. During that time, the Fed withdrew stimulus slowly and raised the rates at a very gentle pace, keeping them around 2 to 2.5%. So even though gold declined, the drop wasn't deep. It was more of a long drift than a crash. Then came October 2018, another turning point. That's when the US-China trade war broke out. It completely changed how investors viewed the global economy. People began asking, is the era of free trade ending? Are the two largest economies on Earth entering a prolonged confrontation? Talks of a new Cold War started circulating, and not without reason. On one side stood the democratic world, on the other, an authoritarian power that had grown rich through globalization but was now showing its teeth. The trade war wasn't just about tariffs. It symbolized a clash of values. And deep down, everyone knew this rivalry wouldn't end quickly. It was the beginning of a new global power struggle, reminiscent of the US-Soviet competition decades ago. In the climate of rising uncertainty, gold started a new uptrend. Then came 2020, when the COVID-19 pandemic hit. The Fed slashed rates and pumped money into the system again. Gold spiked instantly, but only for a few months, as the world realized the pandemic, while severe, wasn't the end of the economy. Confidence in fiat money returned, and gold fell back. Why? Because investors knew the Fed would have to soon start tightening again after pumping so much money to the economy. In February 2022, Russia invaded Ukraine, and gold briefly surged, but that didn't last either. Russia proved too much weaker than expected, and in March 2022, the Fed began an aggressive rate hike cycle. Within less than a year, rates shot above 4%, peaking in November 2022. At that point, markets began to expect, okay, this must be the top. Rate cuts will come sooner or later. So gold began rising again. The cuts came slower than many hoped, but they came nonetheless. Each step down in rates pushed gold gradually higher. And when the Fed officially started cutting in 2024, gold broke out even faster. Then came September 2025, another rate cut, and gold rallied again. But there was a new catalyst this time: the Trump administration's tariff war. Many tariffs jolted global trade, driving up import prices in the US and creating inflationary pressure. At the same time, the administration began massive deportations of undocumented immigrants. And as I have explained in my video about demographics and the economy, that's a recipe for long-term economic drag. Put it all together: trade shocks, political uncertainty, weaker labor force, and looming inflation. And once again, fear and instability fueled a fresh surge in gold prices. So, standing here today, looking into the future, how much longer can gold keep rising? In the short term, say within the next year, I think the odds are high that gold will keep climbing. Why? Two major reasons. First, the rate cutting cycle is already underway. Next year, Jerome Powell will step down as Fed chair, and Donald Trump will almost certainly appoint someone who is fully aligned with him. The new chair will likely move quickly to cut rates and boost growth. That's a huge monetary stimulus, and gold loves that kind of environment. Second, Trump's tariff war probably won't fade quietly. Once rates come down and the government's debt burden eases, he'll have even more room to expand those tariffs, and that, again, will push gold higher. So, in the short run, both falling rates and rising trade tension could keep gold on an upward path. But what about the longer term? There are three big forces we need to keep watching closely. Number one, the strength of the US economy. If America keeps growing strongly, that's bullish for the dollar and bearish for gold. Looking at labor force projections, according to my calculation, from 2027 onward, the US workforce will expand sharply, which almost guarantees another wave of economic expansion. If that happens without major shocks, the dollar will stay strong and gold could struggle. Number two, US government debt. This is the Damocles sword hanging over the entire system. No one knows when it might fall, but if it does, gold will explode. How could that happen? If debt keeps piling up and for some reason stubborn inflation forces the Fed to keep rates high for too long, then the US could face a bond market crisis, even a technical default. That's the moment when this sword drops. And as investor Ray Dalio has warned again and again, the US debt crisis isn't fear-mongering, it's a real risk. Number 3. The biggest geopolitical wild card, a Taiwan Strait conflict. If that ever happens, the question is, how deep would US involvement go? Would Washington step in directly, or just provide support like it did for Ukraine? No one knows. But one thing is certain, if that conflict breaks out, China and the West world, including the US, Europe, Japan, Canada, Australia, would immediately cut economic ties. The US would ramp up defense spending, while supply chain breakdowns would send import prices soaring. Both would push deficits and inflation higher, and could definitely trigger a US debt crisis. It would be a perfect storm, and gold would skyrocket like never before. So, how likely is that scenario? Unfortunately, the probability seems to be rising. We've all heard the top leader of China warning that the world is once again at a crossroads between war and peace. We've all seen the new aircraft carriers showing off their strength. And yes, China's central bank is still quietly buying gold. So the question is, how do you read this risk? Because in times like these, gold isn't just a metal. It's a mirror reflecting our collective confidence, fear, and uncertainty about the world's future. That's the real challenge with gold investing. In the short term, the direction looks fairly certain, but over the longer run, say 2 years or more, things get messy. Big, unpredictable global events can change everything. Personally, I don't allocate a large share of my portfolio to gold, because I dislike uncertainty. If an investment only gives me a 70 or 80% chance of success, I'll treat it as a small speculative play, not a major position. I only go in heavily when I believe the odds are above 95% in my favor. But everyone's risk tolerance is different. If you enjoy taking on risk, gold might be more suitable for you. My friends, I'm Warren. Thanks for watching. If you found this video valuable, please give it a like and hit the hype button so more people can see it. And don't forget to subscribe to the channel, Warren's Real World Economics, and hit the bell so you will be notified whenever I uploaded a new video. And one final reminder, everything in this video is just my personal analysis and opinion. It's not financial advice. Always make your own investment decisions, take your own profits, and bear your own risks.